Hello everyone, today we're with Mr. Tan and we're going to talk about joint venture. Hello Mr. Tan. We often hear stories of foreign business entering Chinese market through establishing a joint venture with Chinese entity. Mr. Tan, could you tell us more about joint venture?
Well, joint venture is one of the most common investment vehicles in China. When foreigners start their business in China, they often use it. There are many advantages to joint ventures. By a joint venture, you can have access to your local partners who can speak and write in Chinese. When you are not in China, they can negotiate for you. And by joint venture, your local partner is able to help you to access restricted markets. They can also help you to promote your products and services in a way that is reasonable for Chinese consumers. So a joint venture is a very reasonable vehicle for foreigners to come into China.
What are the types of joint venture?
Well, there are different types of joint venture for different purposes. That really depends on the client's need, resources, and anticipated business. As we normally see, there are two major types of joint ventures. The first one is equity joint venture. Normally speaking, for this kind of joint venture, the investments comes from both the Chinese party and the foreign party. And the parties jointly invest, operate, take the risk and responsibility for profit and loss. The second type is cooperative joint venture. Normally speaking, this kind of joint venture, the foreign party will provide the majority of investment, while the Chinese party will provide the means of production. Cooperative joint venture is governed by a contract with specific terms of cooperation. And the two parties will share their risk and profit on the base of the contract instead of the ratio of investment.
How does this differ from a wholly foreign-owned enterprise? Also, we can call it UFI.
The difference lies in the equity ownership of the company. A wholly foreign-owned enterprises, or we can also say a WOFI, is wholly invested by a foreign investor or a group of foreign investors. A joint venture, on the contrary, they need to distribute the equities between the foreign party and the Chinese parties.
In such cases, how does one go about selecting the right partners?
This is a very important concern. To select a right partner, a due diligence is a must. We need to conduct a due diligence on every potential partner. What's the history of your partner doing business in China? How can they prove they have been successful in their business? Do they have experience in the industry you are planning to enter? We will find out all these kind of questions by due diligence. We suggest we look for experienced Chinese legal professionals. They can construct strong and enforceable agreements to have maximum protection. Setting up a joint venture is not a few conference call or dinners. Everyone claims they are the best. How do you know who's real and who's not real?
Thank you very much, Mr. Tan.
You're welcome.